What is up, YouTube? I got an awesome one for you guys today. Again, I say that every video, but I really think these videos are super awesome. A lot of people reach out to me. They're talking about their retirement accounts. They're talking about their 401k. All they see in terms of their investments in those type of accounts, those 401ks, are mutual funds, right? The Vanguards of the world, the T. Rowe Prices of the world, the Fidelity funds of the world, but not a lot of people know that there are alternatives to mutual funds that are actually better than mutual funds. They do the exact same thing, but they put more money in your pocket, which is the most important. So what we're going to do in this video is we're going to do a little bit of a challenge, a little bit of a fight. We're going to take the top ETF in the world, and we're going to take the top mutual fund in the world. We're going to compare the two, and we're going to see who ends up winning this battle. The answer might surprise you. So again, guys, clicking buttons, getting inside the computer, mutual funds. Are they better than ETFs or not? You'll find out now. Okay, boys and girls, here we are inside the computer, ready to rock and roll, locked and loaded. Here we go. ETF versus mutual fund. Now, isn't the answer so obvious what you're supposed to do? Now, again, what we like to do here, what I do with myself, with my students on this channel, is what we do is we take what others talk about in the stock market, whether they be professional investors, whether they be entertainers, whether they be bloggers, whether they be newsletters, whether it be Barron, whether it be Jim Cramer, whatever it is. We take what they say and we go investigate. We don't just take what they say and automatically copy their strategies. We don't just take what they say and automatically say their word is gold, like they know more than us. What we like to do is we like to take what they say and we like to dig into the numbers. We like to dig into the numbers to see if what they're saying is really, really true. Everyone says low-cost mutual funds are the way to go. But the reality is, are they? Numbers will tell us. Profitability will tell us. Data will tell us. And that's what we're going to do here. So we're going to take the top ETF in the world and we're going to take the top mutual fund in the world. And what we're going to do is we're going to compare them. We're going to look through about 7 statistics and we're going to see which one is the most profitable, which one will pay you the most. The goal of this video is to pad your pockets with the one, either the ETF or the mutual fund, the top ones in the world, which ones are going to pay you the most money, because at the end of the day, the bottom line is all that matters. So isn't this so obvious, right? Everyone says, hey, Steven, low cost mutual funds, they're the way to go. You just put your money in there, it's going to grow at a very low cost, and voila, 20 years later, it's going to be worth way more. Well, that might not be true. And again, in investing, guys, you need a game plan. You need a game plan. And one of the game plans is an ETF or mutual fund the way to go? And we're going to kind of figure out exactly what that is going to be. So first, what is an ETF? Well, an ETF is a basket of stocks that can be bought, sold, or traded as one single asset or stock. ETFs allow investors to have exposure to multiple stocks at the same time in a diversified way. Each ETF is weighted proportionally based off the holdings of the individual stock in the ETF. And you guys know about a lot of these ETFs. Let's see, FXI is the ETF for the large cap stocks in China. FXE is the ETF for the euro currency. Let's see, FXJ is not one. So FXM is the Mexican peso ETF. IWN is the ETF for the Russell 2000 index. Those are what ETFs are. Right. And on the other hand, what is a mutual fund? Right. What is a mutual fund? Well, a mutual fund, there are investment strategies which allow for multiple people to pool money together and have a manager of the fund buy or sell various assets various assets from various asset classes. Mutual funds are typically managed by an investment manager, an investment advisor, where the manager chooses which stocks, bonds, ETFs, currency to take in and out of the mutual fund. Right? So mutual funds are a little bit more traded. They're a little bit more managed. Right? That's a little bit of the difference. So you came here to figure out if ETFs or mutual funds were the way to go, and by golly, I'm going to give you that information right here, right now. ETFs and mutual funds, as you can tell, they're very similar to one another, right? But looking at pure numbers can tell us which is better to invest in, ETFs or mutual funds. And I'm telling you guys because I wrote these slides. I know exactly who's going to win here. And what's interesting is one wins by a lot, and one actually puts more money in your pocket by a lot, especially when you consider having your money invested in an ETF versus a mutual fund over 10, 20, 30 years. There's a clear-cut winner here, guys. And again, the goal of this video is to put more money in your pocket. And you'll be able to do that by deciding for yourself, should I invest in ETFs or should I invest in mutual funds? So let's meet our competitors for this challenge. All right. What we're going to do is the first thing we're going to do is we're going to look at the most popular ETF in the world. Then we're going to compare it to the most popular mutual fund in the world. And by looking at those two, we'll be able to say, hey, ETFs or mutual funds, it's going to be clear cut for us. So who's our ETF? SPY, the S&P 500 Index ETF. So the S&P 500 Index, a basket of 500 stocks, industrial stocks, healthcare stocks, consumer staple stocks, commodities, right? Technology, small caps, all those guys basket together and give you the S&P 500. SPY is the ETF that tracks the S&P 500's price movements. It's just 1/10 of the price. And it is by far the most liquid stock in the world. When I say liquid, I mean the most participated, right? More people participate in SPY than any stock in the world. In fact, it trades over 100 million shares per day on average. Now, 100 million shares per day on average is cool, but I want to show you what that really means. When I say 100 million shares per day, we're looking at 144 million shares traded last Friday. Now, that's a pretty big number, and the way to tell how much number is, we look at how much notional value that is. So what we do is we take the current price of the stock, 266.51, and we multiply that by how many shares traded on that day. And what we see is if we take the current price of the stock times its volume, we get about $38.5 billion traded in terms of SPY shares on a given day. And what's even more impressive is over 2.5 million options trade on a single day. Now, we talk a lot about options here on this channel. Options are agreements to buy or sell a certain 100 shares of stock per every option that we have at a predetermined price at a predetermined date. Now, as you know, every option is worth 100 shares of stock. So if we want to see how much of an option traded on how much options traded on a given day, the notional value of that for SPY, we take the current price of the stock, 266.51, we multiply that by 100 because again, every single option is worth 100 shares of stock, and then we multiply that by how many options traded on a given day, and we get a total notional value of options traded on SPY on this day of almost $100 billion. So as you can tell, SPY, very, very liquid, a ton of participation, all the big hedge funds and institutions very, very involved with trading that. And what really is the result of all this is you can get filled at any time with any size at fair market value. Now, who's the competitor? Our mutual fund, VFINX. That's the Vanguard 500 Index Fund Investor Shares. For the purpose of this conversation, we're just going to call it Vanguard. Now, Vanguard, this fund has $384 billion under management. That's right, $384 billion in the world are currently being managed by whoever is managing VFINX. That's a lot of money. That's the most popular mutual fund in the world. In fact, over 50% of all employee-sponsored 401ks in the United States are managed by VFINX. So you can tell, very, very popular. SPY, the most liquid product in the world, that's the ETF we're going to look at. VFINX, the Vanguard S&P 500 Index Fund, $384 billion under management. That is the mutual fund, the most popular mutual fund in the world. So we're going to look through about 7 different things to determine if the ETF is better for us or the mutual fund is better for us. So let's see. The first thing we're going to look at is portfolio composition. And what you can tell here and what's kind of cool is they have the exact same portfolio composition as one another. The ETF SPY has the exact same portfolio composition as the mutual fund Vanguard, VFINX. And what's really awesome about that is it really truly allows us, when we're looking at this comparison, to compare apples to apples. One is an ETF with the exact same holdings. The other is a mutual fund with the exact same holdings. We can really compare apples to apples now, which makes this even more realistic. The first thing we're going to look at, it's 0-0 at this point. The first thing we're going to look at is expense ratio. Now, an expense ratio is the percentage of total assets under management that are taken out of the fund or ETF to pay for administrative fees like salaries, back office, legal fees, accounting, etc. But really, an expense ratio is the amount of money the manager of the fund takes out every single year to pay their salaries. So if you have a fund that has a 1% expense ratio and there are $100 invested in the fund, every single year the manager of that fund will take out $1 to pay for their expenses. So what we want to see here is the lowest number. The lower the number, the better. It will be the lower amount of money that the manager of the fund will take out of your pocket. So we want to see a lower number here. For SPY, we have a 0.09 expense ratio. And for Vanguard, VFINX, we have a 0.14% expense ratio. Remember, we want the smaller number. So SPY is going to take the cake here. They're going to be the winner here. The smaller the expense ratio, the less money they're going to take out of your pocket. The next thing we're going to look at is dividend. Now, a lot of people know what dividends are. So a dividend is a quarterly payment credited to the shareholder's account. Right? A dividend is the amount of money that is removed from the stock and paid out to investors. So with a dividend, we want more money. The more money they pay us in cash, the more we're going to be padding our pockets. So opposite of expense ratio where we wanted lower money, with the dividend we want a greater number. So the dividend for SPY is currently, as we're shooting this video, 1.8%. And the dividend for VFINX, the Vanguard Mutual Fund, is 1.76. Now, SPY definitely has a higher dividend. However, right, SPY does not automatically reinvest its dividends, but the Vanguard Mutual Fund does. So I'm going to give a point to each. I'm going to give a point to SPY for having a greater dividend, and I'm also going to give a point for VFINX for allowing you to automatically reinvest your dividends. So the score right now is 2 for SPY, 1 for the Vanguard Mutual Fund. So the ETF is slightly ahead, 2-1. The next thing we're going to look at is barrier to entry. Now this is very, very important. Barrier to entry is super important. When we talk about barrier to entry, what we really mean is how much money does it cost to play ball? How much money does it cost to cross the bridge? How much money does it cost to buy either SPY or VFINX? Well, for SPY, at the time of writing down these slides, SPY was trading for $256.41. And to get involved, your barrier to entry when looking at the ETF SPY, it's the cost of one share of the ETF. In this case, $256.48. If we look at the lowest barrier of entry to invest in VFINX, the mutual fund, it's $3,000. So the barrier of entry to get into the ETF that tracks the exact same holdings as the mutual fund, with SPY, you get to do it for less than 1/10 of the price. So this is kind of a big victory for the ETF. Right now, after our category 4, we're looking at a score of the ETF SPY with 3 and the mutual fund with VFINX of 1. The next thing we're going to look at is the ability to get in and out. This is absolutely critical. Absolutely critical. So when talking about the ability to get in and out, we mean get in and out as quickly as we want at the best price possible, right? So if we look at SPY, with SPY, we can do this. It trades well over 100 million shares a day. If we want to trade any shares, we can do it whenever we want. And the bid-ask spread is only going to be a penny wide, so we're going to get the best price possible. And I'll link in the description the video that talks about the bid-ask spread. Right? So with SPY, we can do it. If SPY is down 2% one morning and we want to buy SPY because it's down, we can do that instantly. We can do that instantly. However, you can't do that with a mutual fund like VFINX. With mutual funds, purchasing only happens at the end of the day, and your investment is tied to the NAV price, calculated at the end of every trading day, right? So there is a NAV price that is the price that the mutual fund shares with all of its clients on its website at the end of every single day. So if you see that VFINX is down, or you think it's down earlier on in the day, you can't go ahead and give Vanguard your $3,000 and have them invested for you right then and there at those prices. You have to wait and see what the price is going to be at the end of the day. This is a huge loss for a mutual fund. A huge loss for a mutual fund, but a big gain for the ETF. At this point, we have 4 points for SPY, which is the ETF, and 1 point for VFINX, which is the mutual fund. The next thing we're going to look for is just, hey, performance. Who performed better? Looking at this chart, we see the mutual fund in blue. That is the index fund for Vanguard. This is taken from Vanguard's own website. In yellow, we see the S&P 500 index. Now, as you guys remember, SPY is the S&P 500 index ETF. It tracks penny for penny the exact same price movement as the S&P 500 does, just 1/10 of the price. So the way to look at this, which again, Vanguard posted on their website, is Vanguard in blue, the mutual fund in blue, SPY in yellow, the ETF in yellow. And as you can see, 1 year, 3 year, 5 year, 10 year, clearly, SPY is the winner. And the only reason there's no comparison since inception is actually the Vanguard fund has been around since 1978 and SPY hasn't. Again, guys, this is on their website showing that SPY is more profitable. At this point, SPY 5, VFINX 1. Ability to reduce cost basis. This is probably one you guys haven't heard before, but when we talk about it, when we reduce our cost basis, we improve our odds of making money, right? If someone owns a stock at 200 and someone owns a stock at 198, the one that owns the stock at 198 with the current price of the stock being at, let's say, 200 has a better chance of making money. That's what we talk about when we talk about reducing cost basis. The only way in the world to reduce our cost basis, which again improves our odds of making money, is by trading options around our stock positions. And the way we're going to figure this out to see if we have the ability and how good of an ability we have at reducing cost basis, we look at the depth of the options for SPY and VFINX. Well, as you guys saw earlier with SPY, the most liquid product in the world, almost $100 billion worth of options traded on a given day in SPY. 3.7 million contracts traded on a given day. Clearly, there's some serious depth if you do want to go ahead and reduce your cost basis. Let's look at VFINX. No good. VFINX does not have any options, so you can't improve your cost basis. You can't reduce your cost basis. Thus, with VFINX, you can't actually improve your odds of making money with options. SPY 6, VFINX 1. So at this point, guys, it's super clear. It's super clear that SPY is the winner, right? If we look at the comparison, they trade exactly the same, right? Which is great because, again, the rest of it is really comparing apples to apples. Expense ratio, we want lower number, right? Because we want to keep more money in our pocket. SPY is lower. The ETF is lower than the mutual fund, right? The dividend, higher the better. We want more money in our pocket. The ETF, again, is higher than the mutual fund. Barrier to entry, we want lower is better. Again, the ETF is lower in terms of barrier to entry by more than a 10 to 1. The ability to get in and out whenever we want. You can do that with SPY. You can't do that with VFINX. You could do that with SPYs because you could buy or sell the shares whenever you want. You can't do that with the mutual fund because, again, they invest your money at the end of the day when they're calculating the NAV price. Annual performance over the last 10 years. Who makes more money? Well, over the last 10 years, SPY made more money than VFINX. It probably has to do with the fact that they pay a greater dividend and also the expense ratio is lower. But either way, and again, this is according to Vanguard's website, the ETF makes more money. And the ETF has the ability to reduce cost basis because you can trade options. VFINX doesn't. Clearly a blowout winner to the ETF. Now let's talk about why you thought, because you did, when you showed up on this video, you thought the mutual fund was the way to go because you've heard your whole entire life that low-cost mutual funds are the best way to invest. But we're here to show you that the numbers don't actually say that. So why did you think that all along? So all along, you guys thought the mutual fund was going to be a better way to invest, but it turned out the ETF, SPY, lower expense ratio, higher dividend, lower barrier to entry, ability to reduce cost basis, all that stuff, all heavily favors the ETF. Now, why haven't you heard that before? Why did you just think a mutual fund was the way to go? Well, mutual funds are very set it and forget it. In ETF, you have to physically go there and buy shares yourself. At the same time, all your 401k options are typically with mutual funds. So you've just had a lot more exposure to what a mutual fund is as opposed to, hey, an ETF, maybe if I take the 10 minutes it takes to actually buy the ETF set it and forget it type of thing. If I just take the 2 minutes it takes me to personally reinvest my dividends in the ETF account. So it's not your fault. It's not your fault if you came to this video thinking that a mutual fund was going to be a better option when we're talking about an ETF, again, because you had better exposure to that type of thinking in your life. But when it really comes down to it, the numbers show that investing with SPY, which has the exact same makeup, it has the exact same portfolio composition as the Vanguard mutual fund, you will make more money with SPY. So if you're interested in getting overall market exposure and someone says, hey, you know what? Vanguard has a really low cost index mutual fund, you should invest it there. You go, no, SPY has a cheaper expense ratio, pays a higher dividend, has a lower barrier to entry. You can buy and sell whenever you want. So I'm going to go ahead and buy SPY instead. Awesome, guys. Thank you guys for tuning in. If you have any questions, hit me up in the comments below, and I'll see you guys in the next video.